Welcome to Angel Investing 101 with guests JJ Singh and Benita Daryani. I'm co-president Alex Montalbini, MS08. Thanks for joining Stanford Angels and Entrepreneurs United today. Our group's mission is to enrich, educate, and unite the Stanford startup community in innovation centers across the country beyond California and New York. Launching in the pandemic, we offer monthly virtual programming for entrepreneurs and their supporters to lighten the journey. The format today will start with an introduction of our guests, followed by their insights from years of angel investing, largely based on questions you submitted at registration. Live Q&A will follow. With several hundred registered to the event today, please use Zoom's Q&A features to ask questions and upvote them. We'll conclude with announcements. Please note that today's event is for educational purposes only and should not be construed as investment advice nor endorsement. This session is being recorded. Now I'll hand it over to Sheila to introduce our guests.
Thanks, Alex. I'm Sheila Pruva, MS in Computer Science from Stanford and a co-president of this group. We are delighted to welcome our guests, Benita and JJ, who will demystify angel investing. Both bring in-depth knowledge gained over decades of building and supporting companies. Jagjo JJ Singh is an investor, board member, and advisor in several healthcare and enterprise software companies. As co-president of Stanford Angels and Entrepreneurs, JJ leads the investment committee, and his investments include Medrio, WorkSpan, Zoom Rides, Erin, Jetlore, acquired by PayPal, and Zero Secure, acquired by Palo Alto Networks. JJ is an advisor to several companies, including Bright Insight, Subtle Medical, Alertive, and Zoom Rides. Previously, JJ was CEO and co-founder of Technicron HealthLink, CareSoft, the world's leading disease management platform, and All Documents. He was also on the founding teams of Chestnut Medical, acquired by Medtronic, and Second Foundation, acquired by FIS. JJ is a guest lecturer at Stanford Business School and Stanford School of Biodesign. JJ earned an MBA from Stanford's Graduate School of Business and an MS from Stanford's Graduate School of Engineering in Engineering Economic Systems. We are extremely grateful that you could join us at this time from India, JJ.
My pleasure, Sheila. Looking forward to it. Thank you.
Benita Daryani is an entrepreneur, executive, and investor. She spent her career in technology in both investing and operating roles. Her portfolio includes Truaxis, acquired by MasterCard, Citrus Lane, acquired by Care.com, Bop.fm, acquired by LifeLock, Milewise, acquired by Yahoo, Axel Hire, and many others. She's also a limited partner in several venture funds. Previously at Google, Benita led global partnerships and closed complex deals with the likes of Amazon and Facebook. She started at Google in sales and operations, where she scaled online sales for Google Print. Benita began investing at venture capital firm J.H. Whitney, prior to which she was in investment banking at Morgan Stanley. Benita earned her BA with honors in economics from Columbia University and her MBA from Stanford's Graduate School of Business. Outside work, Benita spends time with her family and is focused on supporting women in technology globally. She previously served on the board of the International Museum of Women, a global fund for women. A wholehearted welcome, Benita.
Thank you so much, Sheila. Thank you for having me.
Let's start at, well, the beginning. Tell us the story. Why and how did you start angel investing?
So I started angel investing. I really got interested in investing when I spent a couple of years with J.H. Whitney. I spent my time focused on both internet and software investments, so both consumer and enterprise. And I really fell in love with the technology industry back then, and always enjoyed being part of the startup ecosystem. And so I was focused more on growth investing at that time. And so we cut larger checks and, really started working with companies when they were already on sort of a rocket ship growth trajectory. And we're really trying to scale up. And so when I was at Google, I also was working with larger companies and larger partnerships, and always really kind of yearned to get back to those super early stage companies and really at the company formation stage, because I hadn't had a chance to invest in such early stage enterprises in my career. And so when I left Google and I started to advise, I started to see how advising and investing were very complementary. And so I spent a lot of time just getting sort of acquainted with the ecosystem. And as I started to spend more time advising and I started to spend more time investing, I started to do both simultaneously. And so I really, I think, got most interested in investing because of where I live. I live in Menlo Park, and being part of the Stanford GSB network and the Google network, there was quite a few people, friends starting companies, former colleagues starting companies. And so it was a very natural progression for me.
Great. Thanks, Benita. I guess my turn. So roughly about a dozen years ago or so, I was running a company and started investing with friends, other people, other colleagues who were CEOs of companies, saw some innovation on the ground and said, why not? And just like Benita, being based out of Palo Alto this time, I'm about a mile from the campus behind me right here. It's hard not to when you're in the ecosystem around Stanford. You see a lot of deals come through. But I remember now, as I look back, there are three stages. The first was this informal stage where I was in an operating role, but I was look opportunistically for deals with friends. But that changed significantly around 2010 when I became part of Stanford Angels and Entrepreneurs. This is a club we started right out of the engineering school. I ran into an old professor, Professor Ron Howard, School of Engineering, and there, Stanford Angels was kicked off. And we're about 1,500 members now in Silicon Valley. And of course, there are other chapters such as yours, Sheila, called Stanford Angels and Entrepreneurs United. There's chapters out of India, Brazil, Hong Kong, and so on. In that stage, I started more formally investing with colleagues. And then probably finally about 2 years ago, became co-president of the Stanford Angels and Entrepreneurs Silicon Valley chapter again. And this time really kind of got into a formal process of looking at companies with an investment committee and then doing much more diligence. So on Stanford Angels and Entrepreneurs, I'd say we've done about 120 investments over the last 10 years or so, about 10 to 12 a year. And so it's ramped up from being an informal activity to now being pretty centric to what we all do.
Great. Thanks, both. What would you say was your biggest early lesson? JJ, do you want to start?
There's, I guess, lessons or learnings. There are just so many. When you look back over a decade, and of course, I wish I'd done that, not this. Probably if I was to break the lessons down, there'd be in a few categories. The first one is the mechanics of investing. Earlier on, I didn't know whether I wanted to invest 25,000, 100,000, or much more. As an individual angel, you come across different groups, and some have boundaries of what you invest or minimums, and others don't. And it's pretty popular when you're starting out angel investing that you think, why don't I risk X amount of dollars? And what I've come to see over the last 10 years or so is people will say, let me just start small. Let me do $25,000 investments and can move it up to 100,000 or more. And looking back, learning is, that sometimes when you kind of do this, what I end up calling spray and pray model, which is you just put all this money out there and see what will happen, the returns are abysmal. You haven't done the diligence, and all you're looking at is just parking a little bit of money and hoping you'll get lucky. So that's just not the right way to do it. Another is stage of company. I remember investing in stage, Series A, Series B. They were pretty far along, and the returns from those are low compared to something when you get in very early in a seed stage. And then probably the biggest thing I learned was patience. And by patience, let me tell you what that means. I remember a specific instance where it's hard not being influenced by very smart people coming out of Stanford, 2 PhDs dropping out and starting something, and the professors are raving about how this technology is going to change the world. And in an emotional moment, you go ahead and invest without doing any diligence. So I've suffered because of that. and then there's the other idea where on the other you think you have some experience in an area and you have biases really. You don't have knowledge in an area and you end up investing. And or not investing. In fact, one of my most, misses for me was these two people out of Stanford undergrad, second year dropout and do a little app. And I'm looking at the app and going, no way. I mean, this is just, come on, are you kidding me? These are dorm kids being dorm kids. Well, that ended up being a large company. I'll keep the names out of it. So a lot of lessons. Benita, yours?
Thanks. That was great. For me, I think the first thing that I would say looking back is, first figure out, what do you want to get out of angel investing, right? Is this your primary thing? Is this what you do with most of your time? Are you trying to become a professional investor? And are you using angel investing as a way to sort of get your feet wet and learn investing and then maybe raise a fund of your own later on? Or is this a hobby? And are you an operator or an investor or maybe an executive at a big company and you're just dabbling on the side? I think it's really important to figure out what you want to get out of angel investing. Once you kind of figure that out, I think you can start to put together a framework, as JJ said, about what stage is my wheelhouse. What are the areas? What are the focus areas? And what are the stages that really play to my strengths? For me, I spent a lot of time in partnerships at Google, and I touched pretty much all of our consumer products. So anything around search, such as fintech, education, healthcare, mobile, social, commerce, that was one of my biggest areas. Those are all areas where I became, somewhat of a domain expert while I was at Google. And I felt very comfortable with the industry because I knew the participants. We had done partnerships with some of the large industry giants in those areas. And so, I think having that head start in a particular area where you feel like, okay, yes, I have to do due diligence, but I can hit the ground running because I sort of have a lay of the land of this area. I understand how this industry is being transformed by technology, makes a huge difference. And I think in the angel industry and just especially right now, there's a lot of frothiness. There's a lot of noise. It's very busy. There's a lot of money out there. And I think the principle of smart money, that you see in sort of the larger VCs and institutional investing applies at the angel level as well, right? I think entrepreneurs want smart money. And so I think the more that you are an expert or you can leverage where you do have that expertise, then not only are you investing, but you're also potentially making introductions. You're potentially helping the companies, the entrepreneurs with strategy and so forth. And so I think it's important to, like I said, figure out your domain expertise, figure out what stage you want, how much money you want to invest, how many deals you want to do. And I think also building your own personal brand as an angel investor is important, because I think the more people get to know you and hear about you from other angel investors, as big as the world is, it can be very small. The angel investing world can be very small. And so I think starting to build your reputation, that can be through networking, it can be through blogging, even just writing about an industry that you know a lot about, tends to attract entrepreneurs. So there's a lot of different ways you can go about it, but definitely having a good strategy at the beginning makes a lot of sense. And as JJ said, there'll be things that you'll miss as an angel investor. But I think, you have to sort of focus yourself. There's just way too much out there. It's exciting, but there's a lot out there.
Excellent lessons. Now, what are your thoughts on investing alone or with a club or syndicate that pulls together smaller checks, especially as you're starting out?
Benita, okay if I go? That's, to me, that was critical. I mean, the lone wolf who somehow is able to recognize an awesome company with no other interaction is a myth. It's not possible. So a lot of people get into angel investing or invest by reading newspaper articles, and that's probably the worst way to do it. So you do need a set of colleagues around you. So now the issue becomes, how do you go about doing that? And actually, maybe I can share with you how we do it at Stanford Angels and Entrepreneurs, which is a complete volunteer club, if you will. There's no cost to it. There's no fees, essentially. This is just a group of individuals that comes together. So we have about 150 experienced entrepreneurs and angel and investors. So for example, my domain expertise could be in enterprise software and healthcare, while my colleague is security and consumer goods. We have another one who would be more on the search side that Benita is pointing out. We have about 24 professors from Stanford. 3 or 4 of them are world-renowned AI experts. So the idea that you want to invest and leverage skills of colleagues around you is very powerful. So I'm particularly fond of, and that's how we really set up Stanford Angels and Entrepreneurs, that if a deal comes through, you can quickly identify experts in that field, pull them together, and they help each other in due diligence, and then you invest. Our model has been very different, which is we'll see a pitch, and literally in a couple of weeks after that, angels will write individual checks to the company. There is no syndication. There are no fees. We do not form LLCs. And we learned our lesson over the last 10 years, actually. We were set up never to do it. What we found was we could react to deals very quickly. And an entrepreneur presents to us, and literally 2 weeks later, they could walk away with $1 million. And we had a lot of that happen in the last 2 years. While other firms and other clubs and other agencies that are doing angel investing do tend to have a process of 4 to 8 weeks of due diligence, syndication, LLC formation, board rights, information rights, board seats. And we thought that we wouldn't do that. We would keep it more informal and really focus on core competencies. The last thought is we'll actually walk away from a deal if we have no idea how to get into it. We just happened to, particularly in the biopharma stem cell space, for example, from the last 2 years for us. We didn't have any expertise. There was no reason to go forward. So those are some quick thoughts. Benita, yours?
Yeah, I mean, I would definitely echo everything that JJ said. I think there's so much power in the sort of networks that we all have, and their organizations, which are, I wouldn't even call them syndicates, right? They're kind of more just affiliations around Stanford. Berkeley has a couple, Google has one. We have the ex-Google network. And so you don't have sort of extra fees and so forth. You're just sort of leveraging that power of the different knowledge bases that people have from their work experience and their own networks. And so, angel investing by nature, they're not large organizations, can be sort of like a little bit where you feel like a lone ranger. And so the more you can affiliate yourself with groups that have these different experts, I think there's a lot of knowledge sharing, both in terms of sourcing deals as well as due diligence. So I think they kind of fit both. And I think so. Google, we have the one exception I would say is from a syndicate perspective. You might have colleagues from companies that you work with who have started their own syndicate, and so somebody somebody you trust. We've considered that in the past where we've put some money into syndicates that have been started by people that we know personally, and so those are good. That's really not the majority of our activity, but it's not a bad way to just get your feet wet. But it's not sort of my primary focus area.
And Benita, do you invest as a private person or under an entity such as an LLC?
So I invest as an accredited investor, and I don't know if that's something that the group has gone through, or if anyone has questions about that. But there's sort of a couple ways you can become an accredited investor. It's not as daunting as it sounds, but yeah. So I invest as an individual investor. I'm also a limited partner in a couple of funds.
Right. And for those in the audience who are curious, if you are especially US based, I would recommend looking up the SEC, the Securities and Exchange Commission, on the definition of who is an accredited investor. And I think they actually expanded the guidelines on that fairly recently. So transitioning to sourcing and due diligence, the next questions will interest both founders and investors here. How do you source or begin to find companies to invest in?
Sourcing, let's talk about sourcing deals. So let's say you're a person and you're new to angel investing and you've got, I'll pick a number, 100,000 burning a hole in your pocket, and you want to invest it. It is usually better to join one of these groups that's doing something. So let me give you how we source deals. So I'd say about 10 years ago when we started, we were seeing about 100 business plans a year through referrals from faculty at Stanford, entrepreneurs at Stanford, excuse me, the 100 members or so we had in our group, all talking to each other. Excuse me. What has happened now is that we've evolved the model to we see more than 500 to 600 business plans a year. And where we used to have pitch events 4 times a year, where 4 companies would present, we now do 10 companies 6 times a year. So the deal flow has increased significantly. And the primary reason has been affiliations with Stanford, much closer to engineering school, business school, biodesign. So since I teach as a guest lecturer, show up for classes at Stanford Business School in biodesign, I'm able to talk to students and faculty there. Engineering, because I went to engineering school, and we have 6 people in an investment committee that do the same. We have relationships with probably 3 to 4 small VC firms that are very tight, so they share deal flow with us. And then we have relationships with another dozen that are Stanford alums and friends, so they'll invite us in on deals. So we've got deals coming from the VC community, we've got deals coming from the Stanford ecosystem, deals coming from past entrepreneurs who've exited who know. So what ends up happening with us over 12 years or so is that the deal flow has just gone up because the engine, just churns on itself and just increases the network flow. So we're fortunate, I think our location being right here next to Stanford University helps a lot. So we'll see a lot of deal flow. That's how we source deals. Benita?
Yeah, I think the different organizations such as Stanford and Berkeley, and I mean, there's so many different ones are a wonderful source if you're just starting to angel invest. I think, again, for me, a lot of the deals that I've done have come in through my personal relationships with folks that I worked with at Google, through Stanford Business School, and I tend to, again, to really focus my energy on things that I know. So things in the commerce area, both consumer software as well as business software has been a big focus area of mine. And I think that, sourcing it's interesting because I feel like when I was doing VC sort of years ago, before I got my MBA, it was sort of a different industry than it is now. It feels very salesy right now. Like a lot of my friends are in VC. I feel like they spend a lot of time kind of even going beyond networking. And so I think you don't really know where the deals are going to come from. So things like going to networking events, you're invited to a demo day, absolutely go. You're invited to an evening, cocktail event. Hopefully soon these things start coming back, go. And I think there's like I said, a strong network of angel investors, or sort of a strong network of kind of industry experts that you meet through these events. Conferences also are a great area to source deals. Like you go to these, fintech conferences or commerce conferences. I've spent a lot of time going to, like shop.com, things like that, like different ones in the past, and found some really interesting entrepreneurs. And it's funny how people's paths will cross in the future too. You might meet a company, they might have a really early stage product, and then, a year later, they've actually made a ton of progress, and it's time to take a look at them as an investment. So these are the kind of ways that I've really sourced these conferences and in personal relationships. And I've been to some of the Stanford events and Berkeley events, and there's also a few different organizations that have come up and said, okay, we're focused on startups from Israel, or we're focused on startups from India, and things like that. And those are also great ways if you have a particular interest in a region.
Sheila, I just had a question come up from an attendee. Is it okay if I answer it? Which is exactly on this project. Thank you. So Initials PL asked a question as to how do we work with deals that are sourced from the VC network? Do we invest on the same terms and without any fees? The answer is I'll give you a specific example. Typically, a VC firm is raising, let's say, or a company is raising $2 million in a seed round, and the VC firm is putting in $1 million, and there's one more to go. So we'll look at that deal and invest exactly at the same terms as the VCs are doing. Typically, most of the deals we see do have a lead investor, whether it's a safe note or convertible debt note or a equity round of 2 to 5 million or 10 million. The terms are already set. So we're coming in exactly at the same terms as the VC firm. And then you asked a question without any fees. We don't pay any fees, obviously. Nobody pays any fees. It's just an investment like any other company. So thank you for that question. Back to you, Sheila.
Okay, thanks, JJ. How do you diligence early funding rounds amid hype, of the fear of missing out, hope, and limited data? Benita?
That is the holy grail question, right? It's interesting. I think that for me, it's so much about the person, the people, the team, and the product at that early stage. So I like to touch and feel the product and really understand what is the problem that this entrepreneur is trying to solve. Why is this entrepreneur the right person to attack this problem? As in, are they really passionate about it? Are they going to put in the sort of 5 to 7 year or plus slog that it sort of takes to really solve that problem? So I think it's really important at that early stage where you can't fully assess the market. But I also really believe in talking to the market. And so I understand their traction so far. Are there customers? Are there users? How much are they using the product? How much they like the product? Back in my VC days, I've done, probably up to thousands of reference calls, customer calls. So I kind of got that mentality pretty early that you have to talk to the market. And the best way to do that is to just say, hey, can I talk to 2 of your customers? Again, this is assuming you're far enough along in the process. But yeah, I think, looking at the product, I think there's also, it's a lot of talking to people who maybe you're not a product person, or maybe you're not an engineer, but maybe you have a friend who is, getting someone to take a look at the product, see what they think about the product. But kind of the people in the product to me are like the really important things early on. And I'll often just do some quick back of the envelope numbers on what's the growth rate of this market they're going after. If this really gets big, how big can it get? What are the unit economics? Like, what kind of margins are we talking about here? Luckily, in kind of consumer software and, business software, you tend to already have some pretty good margins. But, I think these things are really important to understand: size of market, growth of market, and the people that are going to make this happen, and what it's going to take to make it happen. How much capital are they going to need, and so forth. And I think there's, that kind of stuff, even though it may seem really, really early and it is hard to do, you can do some back of the envelope numbers to get comfortable early on.
JJ, I was just going to ask you to build on that, on metrics or milestones you look at.
Yeah, if there's one thing I could point out to the group here, this is the one point of failure in all deals: the diligence. A lot of us are caught with our own hubris, and I'm one of them. It says, oh, I'm smart enough. The guys I'm talking to are smart enough. This is going to happen. Let me put the money in. And that's just the worst way to invest. And it just doesn't work that way. And if you don't do the diligence, you're just never going to get there. So specifically on the diligence and how milestones are looked at, I tend to break up diligence into 4 areas. Yeah, the market, the team, the product, and financing. So it turns out financing, we don't worry about that much. I don't, because you like the company, you can get them through the network and build. Like, I have an example. 4 years ago, we put in $500,000 as a small group. Then we brought in 10 million from a brand name VC firm, another 30 from PE firms, and 70 from larger firms. And so we had about 100 million over 3 years for this firm. So financing is not an issue. Team, you can tell. The biggest one is market. So specifically on diligence, last week I was looking at a deal in the EV space, and it looked really promising. But 2 calls to contacts in the EV space, both as a competitor and then as a customer, clarified some issues that I was having and helped me a lot in understanding the deal. I've actually gone on customer calls with a startup just to see if they know what they're doing and if there really is demand, just to kind of see as part of the diligence whether it'll work. Also helped build a financial model with a company that I thought was messing up with their financial model, and kind of built it. Ended up not investing, but at least did the diligence. So as this is happening, to the second part of your question on milestones, the key thing for me personally, and then for the colleagues I work with, is product market fit on the milestones. Is this a company that's an idea? Is it a PowerPoint slide stack with 4 smart people? Is there an MVP? Are there customers? Are there revenues? And for me, the product market fit is critical. Has the idea found a real pain point in the market? And to me, if the product market fit is good and there's some early revenue, or the customers are raving about the product, it's a no-brainer. But if the company is struggling to find, and their PowerPoint slides say, oh, we can go into 15 different markets, and they haven't figured out which one, I'd be very cautious. Benita?
Yeah, I mean, I think absolutely, to the extent that there are metrics that you can look at, revenue and growth rate and number of customers, that's great. I think oftentimes there's just sort of people and a product, and you're making a decision, and maybe at that point you say, I'm going to take a look at this down the road. And I think that's perfectly reasonable approach to some of the early stage companies. I think it's interesting. I think that investor intuition builds over time, and so you have to get comfortable with sort of, as you're going along, maybe you don't go into investment on a deal early on, and then the next one you're a little bit more comfortable on it. And I think that's okay when you're first starting out as an investor.
What would you say is the single most important question to ask a founder?
I think for me, it really is about, is this the right person to solve this particular problem? So really just trying to understand why are you starting this company? Why are you excited about this particular problem? And what is it about the solution that you've come up with that makes you uniquely suited to solve the problem? I think JJ talked about product market fit. I think there's also sort of founder market fit as well. And just really trying to make sure the person knows what they're getting into, because like I said, I mean, you really have to look at it as a long slog that you're going to be involved with, and you are probably not going to end up with where you started. And so somebody who's willing to be flexible, willing to, I don't want to use the word pivot, because sometimes it's not a pivot, it's just a little turn. But that flexibility and that mindset and that energy and excitement, I think, is really important in a founder. And so we're in Silicon Valley, and so we're often talking about IQ, but I would say EQ is really important as well, and understanding what motivates that person, and what their situation looks like in terms of their commitment and how much they're going to go the mile for the company. And so for me, when I talk to founders, I spend a lot of time really kind of drilling in as to, why do you want to be an entrepreneur? Because there are quite a few people who want to be entrepreneurs, maybe not necessarily for the right reasons. It can seem very glamorous, but I think when you get right down to it, it's just a lot of hard work and a lot of sacrifice. And so I think when you're putting capital in, you want to make sure that you're really backing those people who are going to go the extra mile.
The question is, what are your top 3 priorities for the year? It's a very simple question you ask the CEO. And that captures everything. Are they looking for funding? Do they know where they're short on skills? Will they be able to hire a management team? Are they focused enough? Can they prioritize work? Do they know if the market's there or not? Can they pivot, to Benita's point? And so the simple question of, do you know what you know? And do you know what you don't know? Is probably what we found to be correlated with success over time.
Are there any tools or databases you use as part of diligence?
Short answer, no.
It's interesting. I think as much as we live in an age where we have lots of opportunity to use online resources, I wouldn't say there's a ton of resources available to angel investors. I think for me, I do often use the GSB library in terms of just market research. If I'm just kind of curious, how big is a market? How quickly is it growing? I'll use that. But most of the time I'm sending a quick email to somebody I know who's either worked in the industry or started a company in the industry, colleagues at Google, friends from business school who have been in areas, and just a quick email to find out what they know. I wish I had a better answer than that. I mean, there are some really interesting sites that track investments, like CB Insights, and there's TechCrunch and VentureBeat, and there are companies out there. Business Insider is an interesting one too, where I'll often just kind of read articles to stay up on the market, but I wouldn't say that they're particular databases as such.
Transitioning to current trends, there's been a proliferation of online investing platforms focused on early stage and private companies. For example, Forge for secondary shares, microventures for equity crowdfunding, and syndicate platforms such as AngelList that pool together small checks. What are your thoughts on these? JJ, would you like to start, and then Benita?
I have not spent much time with these platforms, because what we found is that the power of networking, it's a cliche, but it works. At least for our group of 1,500 entrepreneurs and 150 angels, it's worked really well for 10 years. And I personally enjoy the face-to-face diligence and getting to know a company. The reason I got into it was I just want to be part of the innovation that's happening. Otherwise, why wouldn't I just use my broker to buy stock in a public company? So the arm's length give money to somebody else and let them figure it out wasn't really interesting to me and some of my colleagues. And we stuck with this model where you actually meet people and you do it that way. So I am not that familiar with the other platforms. I've chosen to stay away.
Yeah, I mean, I think there is a lot of cash in sort of the ecosystem. I think that's the net of it, right? I think there's a lot of large platforms that are getting in and they're going earlier stage. Having said that, there's just a lot of opportunity. We're in a very unique time right now. We've been saying that for a long time, but it's going to keep going, I think, for a while. And so there is quite a bit of cash out there, but at the same time, there's quite a bit of opportunity. And so I think that you're obviously going to have certain deals that are oversubscribed, and they're obviously going to be sort of shopped around, and people are going to be putting money in. But I think, again, if you have a really key focus and you say, okay, I'm interested in fintech, or I'm going to invest in underrepresented minorities in a specific area, I think you can do that, and you don't have to worry that the big guys are coming in there and changing terms and things like that. I think there's sort of plenty to go around, and the more focused you can be, I think the better off you're going to be. And I think that in particular, this trend of underrepresented entrepreneurs, I think you see it both on the investing side and the entrepreneur side, and helping support some of those groups is a really great thing to do right now, and a really great place to spend your time. And that's where some of the deals, I think, are going to come out that, just like in normal industries, Google can only kind of get to so much, right? And there's going to be startups that are going to come out and they're going to start things that Google's not even looking at. It's the same thing in the investing area. You're going to have the big giants. They're going to focus on these big deals and where there's a lot of buzz. And then you're going to have all these other really kind of grassroots efforts that you can get involved with and really make a difference and move the needle. So I don't really think that's changed things too much, kind of from where I sit.
There's a question exactly on this from Initials PM. Very good question, which is, if the investment's too small, does the company pay attention to you? That's exactly what you're asking, really, when should I invest with colleagues as part of a group or just give it to a platform? So we found that if you walk around with a $25,000 check, nobody's going to listen to you. They'll take your money and that's it. You don't really get involved. But specifically as an example, last year we did deals where 5 of us sat around the table and were able to put $1 million together through our networks and really help the company along. One of the people actually started advising the company. And so knowing the company, the domain, and putting value in a larger amount by pulling colleagues together is a much more influential, interesting, and better way to go about the investing.
So last question before the live Q&A. Benita, you touched on the giants. So institutional investors such as Tiger Global are reportedly investing directly in earlier rounds. What's the impact on the angel ecosystem?
I think the rounds just keep getting bigger, right? I think now you have sort of seed and then you have pre-seed, and so I think whereas before you might have had angel investors saying, "Well, I'm investing in the seed round," now you have kind of the pre-seed and then you have the founding stage, and so I think things have just gotten a little bit more bifurcated and segmented down. So from where I sit, I haven't seen much of a difference. JJ might have a better perspective on that just because of the volume that Stanford sees.
It's a very interesting question, Benita. You're absolutely right. There's a lot happening. And so we chose to take a collaborative approach. Let me give you specific examples. So it's not just the Tiger and all large, we have $1 billion PE or $5 billion PE firms, $1 billion VC firms, all coming up with seed stage funds. So they'll put aside 100 million, put a partner on top of it, or 50 million, and say, go invest $500,000 to $1 million in a bunch of angel deals. And so as an angel group of 150, does it help us or hurt us? And we chose to 6-7 years ago say, it's got to help us. So we now work with them on a lot of these deals. Specifically, there's this lesser known East Coast school, happens to be in Boston, where I believe they have a business school that shall remain unnamed. Well, I'm talking about Harvard, of course. So Harvard and Stanford have been doing a combo event, and we're going to do one in September. And we did one last year. So we're working with other angel groups like that. We do them with Berkeley Angel Network. And then on the VC side and the other large side, we'll share deals with them. So we'll take the top deals and say, what do you think of this? Or if they have deals, they'll call us in. And what that's done is it's really sped up the pace of investment. So you'll see a deal on the first of a month, and they'll be invested, they'll be done within 2-3 weeks because everybody moves so quickly. So we've taken it as an advantage because our goal at the end of the day is to just take our check and put it in an interesting company. And so if you have relationships with these tigers and others, a collaborative approach increases deal flow, gets you to see really interesting deals, and you go from there.
Thanks. Now it's time for the live audience Q&A. Once again, using the Zoom Q&A feature, you may submit questions or upvote them, and it looks that we have quite a few already. Now, do you have an approach you recommend for founders on deciding which angels to approach?
Yeah, that's probably one of the, in our due diligence, we tell angels, don't take our money if there's no relationship, frankly, because we're here to help you build a company. And so a tip to a founder who's looking at different angel investors is, and having been actually, when I was CEO of a company, I raised $2 million from, I think it was a dozen investors. And I learned my lesson that if you get the wrong angel investor earlier on, they can be really burdensome to manage. So it's better to take, $2 million from one investor who's professional, and you meet them, let's say, once every 2 months. But if you take a dozen angel investors who are calling you all the time as to how you're doing, it becomes really burdensome. So you want to be careful how you choose an angel investor. They've got to be professional in their approach to you. They should have done this numerous times. And that's what I'd recommend. Make sure you do the diligence on the angel investor themselves too. Having said that, if you know how to manage investors and you just need to raise 10 checks of 50,000 each and take $500,000 and go along, just do it. But set up a mechanism that keeps angel investors informed. Maybe once a quarter you tell them what's going on, or a newsletter. That'll help you manage them.
This is again from another founder. If an angel or a venture fund contacts a founder to invest in their company, and you're not really looking for investment at the time, should you talk to them anyway, or do you think it would be a waste of time, assuming it's not Vinod Khosla on the line?
I can take that. I mean, I think fundraising in general is obviously a very big commitment and time investment for an entrepreneur, right? And I think that I think you have to take that case by case. If it's somebody who, again, is a domain expert and you think it's just a good relationship to have, why not have a coffee and so forth? But I think in general you have to be pretty disciplined about your time and try to keep fundraising to certain windows of time that makes sense for your company, because you have to be company building. That'd be my overall advice.
Thanks. Now, could you offer maybe an idea of what type of personal rates of return an angel investor could expect?
We struggled with that question as a group. There was an attempt 2 years or 3 years ago to say, why don't we look back at all the investments and come up with the IRR across the 100 companies? And it turns out that we were never set up to do that. I mean, we are individuals who come together on different companies and invest. And so each individual investor has kept track of their own IRR, hopefully over time, as to what makes a good deal for bad deal flow. But generally speaking, the guidelines suggest that if you can get somewhere between 10 to 20% or 5 to 20% in stocks and bonds in a portfolio with your broker, and then if you look at VC returns over 10 years that are in the 20 to 40 range, and I'm deliberately choosing a wide swath, maybe let's say 25, 30%, that may be another way to do the IRR calculation. Having said all that, I find that angel investors are not really that analytical and measure IRR across their portfolio. What they tend to do is say, am I going to make 10x or not? If I'm going to put in 50,000, am I going to get 500,000 out, and how long? If I put in 100,000, can I get to $1 million? So they tend to think in kind of the times X return. Obviously, there's an IRR calculation underlying it. And my suggestion is, if you can't see a 10x, especially because you're doing investing at a seed stage, which is usually under 10 million valuation, and if you don't think the company is going to get to 100 million valuation, you shouldn't be touching it. Because over time, unless you do enough of these 10x guesses, you don't get to 10x. You get maybe 1 out of 10. So that's one model to use when you're thinking of returns.
Vinita, the next question is for you. A lot of reasonable investors put a lot of money in Theranos. How do you avoid that fake it till you make it situation? What did investors do wrong there?
That's a tough one. I mean, a tough one in the sense that I think all the things we've talked about in terms of your due diligence and really kind of sticking to a framework in terms of range of valuation, you would be interested in proof points, all that's, all that, you can do all that right. And when you start to get into sort of areas where there's potential, cover-ups and things like that, that's very hard as an investor to see. So, I mean, I would say really just guarding against groupthink is the most important thing as an investor. Sticking to your instincts, sticking to your frameworks and your analytics is really important, and not getting caught up in a lot of the noise and a lot of the thick, which, I think as we talk about Silicon Valley and we see these new areas sprouting up of investing hubs and activity, I think the reason why that, to me, that is very appealing is because I think when you do live in a place for a long time, there can be groupthink. And so I think that it's a really great thing for VC and angel investing in general, that you've seen this proliferation of investing into different geographies, both in the US and globally. And so you start to see kind of this diversity of thought. And so I think always as an investor, embracing that diversity of thought and sticking to what you know and what you believe in is really important, because it is easy to kind of get hung up or to kind of go with the flow, so to speak.
Now, if you have an entrepreneur that approaches you to raise angel funds, and they already have, let's say, a term sheet from a venture capitalist, do you just accept the valuation and the terms they give you, or are you in a position to potentially come up with your own valuation?
I could try that one. When you're talking to an entrepreneur, and I'll give you specific examples, and they come to you and they say, look, I'm raising $1 million and somebody gave me a valuation of 7 million. What we found is it's not in our best interest to start negotiating valuations till you really understand the business. So we'll do the due diligence, we'll look at kind of, where the company is, look at the overall stack of investments. So for instance, if the other VC firm is a credible firm and they came up at 7, it's an easy phone call to figure out why. And out of the million, if they're putting in 750,000, we have to put in 250. We'll just take it and move on, or we won't because we think it's too expensive. But we don't get into negotiating the valuation because that company already has a term sheet on the table in your example where you already have a term sheet. And we found that over time, it's just not in our best interest to start negotiating hard with entrepreneurs. Because remember, we tend to be both entrepreneurs and investors. And so we tend to see both sides of the table when we're dealing with companies.
Okay, last question. Do you have any tips for a company executive who's invested in around 20 startups and seen good returns on 4 exits, and now is considering switching from hobbyist to professional angel? JJ, would you like to start? I see you grinning.
Look, if it's going great, why do you want to change anything? You had 20 great investments, 4 exits, you're an executive. Why would you change anything? If you've got a good balance going. However, if you think you're getting to a stage where you don't want to be in the operating side of the business and just want to do this full time, then yeah, it's a personal choice. But I'm a big believer in if things are going well, don't mess with them.
I think that, there's a lot of value in keeping your day job as an angel investor, whether you're an executive or running your own company, you bring a lot of value to entrepreneurs by doing that. And so I think that it's what's great about angel investing is you can do both. You can make it a full-time job, but you can also keep it as a hobby. And I think you just get better at it as it is a hobby. It really can be something that mutually reinforces each other. Reinforces investing and vice versa.
We're coming up on time now, so I'd like to thank the audience for their participation and all the questions submitted. Thanks very much, Benita and JJ, for joining our community today. This was a wonderful discussion. Thanks for sharing your wisdom. We've learned a lot. I'll hand it to Co-President Alex for announcements.
Thank you so much, JJ and Benita, for the wonderful discussion today. We have a few announcements to make before we conclude today's event. If you are a startup founder or know one interested in pitching to angel investors across chapters of Stanford Angels and Entrepreneurs, please share a business plan for consideration for our summer curated pitch in July to the email in the chat. Accredited angel investors who'd like to attend curated pitch events, please sign up at the link in the chat. We are excited to offer the opportunity for team building through our LinkedIn group. Meet potential co-founders, team members, and subject matter expert advisors. This concludes the session. Thank you so much for joining us.